Hello everyone. Welcome to video 9 of chapter 7. This is the last video of the chapter. The last topic we're going to discuss is foreign source income. Foreign source income comes into play when you get income from another country. If you have investments, say you invest in an American company like Google. If Google pays dividends, that is US sourced income. So what happens is when a dividend is declared, the US government will withhold a portion of that dividend as their tax withholdings. So I will have paid taxes in the US, but because I'm a resident of Canada, I have to report all of the income to Canada. So Canada sees you got paid a dividend, but we recognize that you've already paid some of your taxes to another country. They don't want to tax you twice. The rules of foreign tax credit is to help avoid double taxation. So what happens is we're going to report your taxes that you owe normally, but you'll get a credit for taxes already paid somewhere else. Let's go through some of the slides just to discuss the theory, and then hopefully going through the exercise will help drive home um, how to calculate the foreign tax credit and what effect it has, whether that income is business or non-business. So residents of Canada are subject to tax on their worldwide income. So if you get income from a foreign nation, you will be taxed in both Canada and likely that other country as well. So the foreign tax credit is provided to avoid excess tax or potentially double taxation. This foreign tax credit is calculated slightly differently between whether it's non-business or business income. The foreign tax credit is meant to represent the amount of Canadian tax the individual would have paid if they had earned the income in Canada. So the thing about the foreign tax credit is the tax credit will never be more than what you would have paid Canada's taxes. Canada's calculating your taxes owing, also known as tax otherwise payable, and then you get a credit for what's already been paid to another government. So let's say Canada was going to tax you 20%, but the US taxed you 25%. They're not going to give you the full tax credit because Canada was never going to receive that 25%. If I earned $100, Canada says, okay, you owe 20, and I say, okay, well, I've already paid 25. They just say, pardon me, they just say, okay, then I guess you don't owe us the 20. We'll give you the credit for it. But they're not going to pay you $5 to make up for taxes paid elsewhere. They're just saying you don't have to, you get a credit against what you owe us, but we're not making you whole. So you don't get back the full credit. Foreign non-business is the more complicated tax credit. This includes foreign employment, capital gains, rental income, foreign investment income. The reason it's more complicated is because the maximum tax credit you can get is 15% for non-business income. So if the US taxed you 25%, your tax credit isn't going to be more than 15. So if I earned $100, got taxed 25% in the US, my tax credit in Canada is only $15. I paid 25, but I get a credit of 15. Because they acknowledge that this maximum could be less than what the other country paid, the excess amount, so I'm getting a credit for $15, that extra $10 I paid will be considered an expense related to that foreign non-business income. So I get to deduct it. So if I earned $100, but I paid 25 to the US, I will get to subtract $10, the excess amount, from that $100 of income. So I earned $100. My excess taxes was 90, so I get to excess taxes was 10. So I expense the 10 from 100 and now my income's $90. Then I calculate taxes, then I get a credit for the $15 foreign tax credit I would have I had I had paid, yes, I had paid to the US. So it's complicated because you have to figure out the foreign tax credit and then deduct the excess amount earlier in the calculation. This will be shown to you during the exercise. Business income is the easier side of it. There's no limitation on how much foreign taxes can be claimed as the foreign tax credit. It's only limited by the Canadian tax that would have applied. In this chapter and in tax one, just worry about how much foreign taxes can be claimed. In the second course, tax two, we will revisit foreign source income and we'll show you the formula on how to calculate tax otherwise payable. But the cases we give you right now, we'll just say they paid $8,000 in foreign tax. What's the foreign tax credit? So that all might have been confusing. Hopefully, going through the exercise will help clear it up or clarify how to do this calculation. Johns earns foreign source income of $30,000 in the current year. The foreign country charges an income tax rate of 25% on that income. So Johns received $30,000, but the US held on to $7,500. It just says foreign country. Let's just say US for an example. So they declared dividends of 30,000. The government held on to 75 of it. So John's only collected $22,500. His total income is the 30,000. 7,500 counts as amounts he's already paid. If the personal federal income tax rate is 29%, determine the impact on taxable income and the federal income tax payable, assuming this foreign source was one, non-business income, or two, business income. So we're going to do this calculation twice and show you the differences. So foreign source income, the foreign income was $30,000. Our 15% for our 15% maximum credit for non-business is $4,500. So we collect our income is 30,000, our maximum credit for non-business income is 45. The withholding rate was 25%, and the marginal tax rate is 29. So starting with, I like to start with the business income because it's more straightforward. The amount received was 22,500, but that's because foreign tax of 7,500 was withheld. So our inclusion of foreign income is still the full 30,000. It's not based on what you received, it's the entire amount that was declared to you. So even though we only received 22,500, we do have to report 30,000 as the income. Business foreign tax credit has no limitation. So we had $7,500 withheld from us. That's 25% of 30,000. So the US government held on to 75%, so we get to use 75,000 or 7,500 as our tax credit. So $30,000 was the income, 29% our tax rate. We owe $8,700, but $7,500 has already been paid. We just have to pay the difference to Canada of $1,200. This is how much we owe to Canada. So the total tax cost is 7,500 plus 1,200 we owe to Canada, $8,700. That's the simpler calculation. Our total income times our tax rate minus what we paid the foreign government. Non-business income is slightly more complicated because we have a 15% maximum on our foreign tax credit. So our income is still $30,000. They held on to 7,500. So the US government held on to 7,500. Our maximum credit is 4,500. So the difference between what was withheld and our tax credit is $3,000. So that excess withholdings is treated kind of like an expense against our property income. So our total income's $30,000. We subtract the excess withholdings. So we're only going to report $27,000 of income. That is our foreign taxable income, 27,000. Our tax rate of 29% on this amount of income, we owe $7,830. That's how much the government calculates that we owe in taxes. But we've already paid some of those taxes. So we get our foreign tax credit up to 15% of the total payment. So 15% of 30,000 is $4,500. So we owe $7,830 to Canada. They give us a credit of $4,500. We still owe $3,330 to Canada. So our total taxes payable, we paid $7,500 to the US. We pay $3,330 to Canada. Our total tax cost is $10,830. Because our tax withholdings was more than our 15% maximum, that means we will end up paying additional taxes. We didn't get our full credit, so it's increased our total tax cost. If the tax withheld was equal to 15%, if we do the withholding rate 15%, if the taxes withheld was only 15%, now our total tax cost is the same, whether non-business or business income, because there would be no excess amount. There's no amount of taxes we paid that we're not getting a credit for. So if the withholding rate is up to our maximum, we're in the same position. Like our total tax cost is the same as if we had paid it in Canada. When the withholding rate goes above our 15%, we're not getting the full credit for what was withheld from us. So there is an increase in our total tax cost. For this reason, if you have US investments, you can go to the IRS. There's a specific form, I think it's called a W-8, where you fill it out and say, I'm a resident of Canada. I'm a resident of Canada. Please limit withholdings to just 15%. So when Google declares a dividend, if you have this paper on file with the IRS, when they go to take the withholdings, they will know to only withhold 15%. Normally they'd withhold 20 or 25, but you filed the paperwork, they will only withhold 15%. So your total tax cost won't be inflated. Um, that form is not going to be tested. That's just for your information. If you have US investments, check to see at what rate your withholdings are being held from you. If your withholdings are more than 15%, then maybe it's worth looking into filing that W-8 form with the IRS so that you can save yourself those additional taxes, that small portion of double taxation you're suffering. Okay, that is foreign source income. The key to this calculation is know when business income and non-business income. Know when the income is one of these two types, because if it's non-business, then you need to figure out the maximum tax, the maximum credit, and subtract the excess. So that is our final video of chapter 7. Chapter 7 is the last chapter of tax 1. So we are done with the course material. If you have any final questions, please feel free to email me. Otherwise, best of luck on the last quiz. Best of luck on your exams. And I will see you in the next course. Thank you.